pips, pipettes, commissions. The number on your screen isn't the cost you pay. Here's the real math.
A pip is the fourth decimal on most currency pairs. On Euro USD trading at 1.0823, that last digit, the 3, is your pip. Move from 1.0823 to 1.0824, you've just earned or lost 1 pip. Simple, except for the yen. On USD JPY, a pip is the second decimal, not the fourth. That's just convention, and it's the first thing every beginner gets wrong. They size a yen trade like a major and end up off by 2 decimal places on their risk math. The exact same dollar exposure can look 100 times bigger or smaller than it actually is, purely because you misread which digit the pip lives on. Now the money side. 1 pip on a standard lot, 100,000 units of currency, is about $10. Mini lot, $1. Micro lot, 10 cents. That's the Rosetta Stone of Forex P&L. Pip value times stop distance equals the money at risk on every trade you'll ever place. And it's the same equation that explains how a 20 pip stop turns into a 40 pip loss on the wrong day. We'll get to that. But first, look at your platform. Euro USD probably shows 5 decimals, 1.08234. That last digit isn't a pip, it's a pipette, 1/10 of a pip. Brokers started quoting in pipettes because spreads got too tight to express in whole pips. When a raw spread broker advertises a 0.1 pip Euro USD spread, they're really telling you it's 1 pipette wide, the 5th decimal. Round that to whole pips and you've erased the entire selling point of the account. Read it this way. 4th decimal, pip, 5th decimal, pipette. A spread quoted as 0.3 means 0.3 pips, which is 3 pipettes, not 3 pips. Confuse those and you'll think you're paying 10 times what you actually are, or 1/10, depending on which way your brain rounds. That precision matters. On IC Markets raw spread accounts, typical Euro USD runs 0 to 0.2 pips during liquid hours. That 5th decimal is the entire competitive moat the account is built on. Strip it and the account looks identical to a standard one. Now the real number. The spread is what your broker marks up over the raw interbank price, the gap between what you can buy at and what you can sell at right now. That gap is your cost of entry every single time you click. Here's the all-in picture for one standard lot of Euro USD, round trip. IC Markets raw spread, 0 to 0.2 pips plus a $7 commission, total roughly $9 per lot. Pepperstone Razor, same structure, 0 to 0.2 pips plus $7, $9 per lot. OANDA Standard, 0.9 to 1.2 pips, no commission, about $10 per lot. eToro, roughly 1 pip flat, no commission, $10 per lot. Plus500, around 0.6 pips, $6 per lot. See what that tells you. A 1 pip commission-free spread costs you roughly the same as a 0.1 pip raw spread with $7 of commission stacked on top. The headline number isn't the cost, the all-in round trip is. That's the only number that matters. This is the mechanism most beginners miss. They see 0 pip spreads in an ad and assume free trading. The commission lives in a separate line item, and on a raw spread account, it's often bigger than the spread itself. So when you compare brokers, add both lines, spread plus commission. Anything else is marketing. That's the calm side of the story. Here's the expensive one. Spreads aren't static, they're a live function of liquidity, and liquidity collapses during major news releases. A Euro USD spread that's 0.1 pips at 10 in the morning can blow out to 4 or 5 pips during the 2:30 p.m. non-farm payrolls print. That's a 50-fold widening in seconds. If you place a market order at the exact moment of release, you pay that widened spread going in, and you pay it again going out. But the spread isn't the only thing moving. Price itself gaps. Your stop loss, set 20 pips below entry, doesn't trigger at 20 pips below. It triggers at 40, because slippage and spread compound. The market jumps over your stop level and your broker fills you at the next available price, which during NFP can be brutal. That's the trap. 20 becomes 40, not because anyone cheated you, because the spread widened 10 times its normal value and the slippage stacked on top. 2 costs, same trade, same second. Professional traders handle this 3 ways. They flatten positions before the release, they widen stops to absorb the volatility, or they simply don't trade through it. Beginners do the opposite. They hold a tight stop into NFP because they think they're protected. They're not. That tight stop is the exact thing that gets blown out the fastest. One more wrinkle, because this trips people up constantly. The pip convention only cleanly applies to Forex. Move to CFDs on indices, stocks, or commodities, and the math shifts under you. The S&P 500 CFD. Brokers quote in points, not pips. 1 point is roughly $1 per contract on most platforms. Your sizing thinks in contracts, not lots. Gold. 1 pip is often 0.01, a 1 cent move per ounce. Sized in contracts again, not currency units. Apple stock CFD, quoted in dollars to 2 decimal places. Your P&L scales directly with share count. No pip, no point, just price times shares. The underlying math is identical across all of them. Pip size or point size or tick size times position size converted to your account currency equals your dollar P&L. The formula doesn't change, the contract spec underneath does. Every product you trade has its own spec sheet, and that spec is where the pip lives. Read it before you place the trade, not after. So pull it all together. 3 rules. 1. Always know your pip value in dollars before you click buy. Standard lot, $10 a pip. Mini, $1. Micro, 10 cents. That's the constant in every position sizing equation you'll ever write. 2. Compare brokers on all-in cost per round-trip lot, never on headline spread. A 0 pip account with a $7 commission is roughly a $9 lot. A 1 pip commission-free spread is roughly a $10 lot. They're within $1 of each other. The marketing language hides that. The math doesn't. 3. Respect the news calendar. Remember the 20 pip stop that becomes a 40 pip loss? That's the standard NFP outcome for traders who didn't check what was coming. Spread widens tenfold, slippage stacks on top, your stop triggers at the worst possible price. Flatten before the release, widen the stop, or sit it out entirely. A pip is a tiny number, 4th decimal of a price, but it's the unit your entire P&L is measured in. In the moment you stop treating it as math and start treating it as a marketing label is the moment a broker's ad copy starts costing you real money. Treat it as math. The math is simple. Pip value times stop distance. Every trade, every time.
Pipe value times stop distance. That's every trade, every time. Check the description for the complete breakdown.